Howard, welcome to the Building and Growing podcast. We're delighted to have you here today.
Happy to be here, mate. Happy to be here.
Excellent. Howard is a venture capital lawyer at Fladgate, which is a very exciting profession. So we're eager to hear more. But would you like to start off by telling us a little bit about yourself and about your experience, Howard?
Yeah, sure. I mean, so I'm a corporate lawyer by trade, but I very much specialize, and almost to a ridiculous degree, in venture capital. So as much as I'm perhaps advertised as doing a bit of M&A, a bit of private equity, I really shun those as much as possible and just focus on doing VC and kind of leave that other stuff to other people more qualified in my firm. So I mean, VC is really it's really by far the dominant sector with which I operate in. So I work on investor side and company side deals throughout, mostly UK, but a lot of Europe as well, and occasionally actually the US. So I'm doing a US deal at the moment for one of my investor side clients.
Okay.
So yeah.
Fantastic. And, how did you get into that niche? Because I'm sure there's many lawyers out there working on, many different sorts of things with corporates. Some might be lucky enough to work with startups. London's a great place to be in terms of working with tech companies. What was your journey into this niche?
That's a good question. So I started off as a corporate lawyer. I was in a firm called Olswang, which is now merged into a much larger firm called CMS, and I trained and qualified there as just sort of general corporate lawyer.
Okay.
And then I went from there to a US firm for about 3 years, and that was right around the time of the credit crunch and the financial crisis of like 2008, 2009.
All right.
And so for the first half of the time that I was at a big US firm, it was exactly as you'd imagine a big US firm to be, which is just incredibly hardworking. You never really see the light of day, lack of sleep, sort of nose to the grindstone kind of thing. And it was great as far as for an educational perspective, just in terms of just being right in there and just non-stop working and learning on the job and being thrown in at the deep end. And it was great from that perspective. But then obviously when the credit crunch hit, it went very much from feast to famine in a very short space of time. And so the second half really of that was almost doing nothing, virtually nothing, because I think the London offices of the US firms were really the first to kind of take the hit on people sort of cutting back on legal fees. So at that point, it was around the time that I was getting married, and I wanted to be able to see my wife and not just spend all my time in a law firm. So I moved in-house, and I thought that was the move that you were supposed to do around 2 to 5. And I never had any desire to be a partner in a law firm.
Okay.
I always thought I'm going to move in-house, and then that's going to be it. No more timesheets, 9 to 5. I'm done. And I joined Fidelity, the asset management company.
Yes.
And they have a proprietary investment arm that's now known as 8 Roads, that previously was known as, well, it was known as Moonray Investors, and it sort of formed part of, it had sort of a property arm, it had a kind of corporate development majority hold type of an arm, and it also had a venture capital portfolio.
Fantastic.
And then over time, actually the thing that really turned it was my ex-boss at Fidelity, an amazing, wonderful guy called Fraser McKee, who I'm still very good friends with actually. He there was no desk for me in the London office. And he said, well, why don't you sit with the venture guys? Because they need to be separated from the public side of the Fidelity, just purely from a kind of information barrier perspective.
Sure.
So they had their own section of the London office. And he said, they're all about your age. Why don't you go in there and sit with them? They've got a couple of spare desks in there. And that was really, strangely enough, the thing that changed the trajectory of my entire career, because then I sat in with those guys.
Yeah.
Sat in on some of their meetings, kind of help them pull together term sheets, and sort of understood really from their perspective how a term sheet was crafted, how they came up with deciding how to construct a liquidation preference and that sort of thing, and really just picked up venture from there.
Fantastic.
And from there for several years I then just did all of the kind of European venture deals from an in-house perspective.
Yes.
And then I had the opportunity to move back into private practice, which I did, and I joined a very small kind of boutique firm that just did venture capital deals.
Wow.
And then that went tremendously well, and then I moved to a slightly bigger firm, and then that went tremendously well, and then now I'm at Fladgate. So it's been since coming back from in-house, it's really been a case of going back into private practice, and oddly enough finding myself really loving what I do and actually really enjoying being a partner in a law firm, which is not something I ever thought that I would ever like to do or want to do.
Yeah.
So it's been a really interesting journey, and a really good one. I'm very, very, very thankful for it.
Yeah, that's fantastic. And really, I guess part of it, is down to luck in terms of where you were seated, but I'm sure that there's been a lot of hard work along the way, given the volume of deals and the deal sizes, I imagine, may have grown significantly from when you started relative to, I know we're in a bit of a low funding environment at the moment, but relative to, say, last year.
Yeah, absolutely. Because I think, you're exactly right. So that's one thing I would absolutely hold my hands with and say, I don't think I could ever claim that any of this was by design. There's a huge amount of luck involved with just where I was seated, but also, venture is really having its day in the sun, or having its time in the sun over these most recent years. It's so to be in this sector at such a good time, and with the kind of trajectory that it's experienced over the last few years, especially in Europe. Has been amazing, and that's really sort of supercharged my career and sort of the activity that we've experienced. And as a result, I've been able to kind of grow my practice quite substantially. And then obviously, coming from in-house, a lot of the people that I work with are ex-colleagues of mine that were in Fidelity and are now subsequently moved to other funds, have kind of eventually become general partners and managing partners at other funds. So I already kind of had an inbuilt network coming back into private practice that perhaps other people didn't have, and it's sort of grown from there. So a lot of different factors all coming together to sort of create what's been a really fortunate time for me.
That's fantastic. One thing that I guess I really take from that story is the power of compound, because I guess every year that goes on, let's say another fund manager left Fidelity and started a fund or joined a different fund, and then you may have been introduced to other people within those networks, and you stayed within VC and have reaped the benefits. So
yeah, absolutely. I think because VC, I always say this, VC, rightly or wrongly, is actually a fairly closed off ecosystem as far as it's populated by people that really know what they're doing, but it's also one of those industries where a lot of people are trying to kind of break in, I suppose is the right way of putting it. And you have, for instance, corporate venture capital. You have sort of, private equity players that are trying to shape their deals to look more like venture capital. And then you have core venture capital, where you have sort of all of the traditional, actual historic venture capital players who were doing venture capital, both investors, but also sort of law firms, service providers, and were sort of doing it before it had its time in the sun, before it was so popular. And so with all of, in the bullish times, in the really great times that we've had recently, you've had a lot of people who weren't previously in the ecosystem trying to break their way into the ecosystem. And I think certainly by being both friends and contacts and clients who are sort of who are within those funds has been sort of a good way of kind of being able to have friends in those places, and to be able to vouch for you and sort of say, okay, listen, he knows what he's doing, and he's not a newcomer and things like that. So that's been nice. And you're right, there is a compounding effect, I think, to all of that.
Yeah, fantastic. So are you able to tell us about the process from your side when, let's say, a founder comes to you in preparation for an investment round?
Sure. So, I mean, it's I suppose it's slightly different if it's like an investor who comes to you versus a founder. But in both cases, usually they come to you either around the time they're about to sign a term sheet, hopefully before they've signed a term sheet. And that's the slight mistake that a lot of people make, is they come to you with a term sheet that's already been signed. And what's slightly difficult about that is if they've signed up to something that maybe you wouldn't perhaps have agreed to if you'd had the chance to advise them, because it's very difficult then, although term sheets by their nature are non-binding, when you get into the drafting of the long form documents, it's very hard to kind of row back from something that somebody's agreed to in the term sheet. And you'll always just find fairly that the lawyers on the other side say, well, this is what's in the term sheet, so why are you kind of changing or deviating from that?
Does it happen often?
It doesn't happen. Well, it happens often that somebody comes to you with the signed term sheet that's fully baked, but it thankfully doesn't happen too often where you then read it and think, oh God, why have you agreed to that? And it's so it's thankfully it's rare in that instance, but it's still, I think, helpful, because oftentimes I think you have founders who sign term sheets perhaps without really understanding what some of the terms mean, or the repercussions of what they actually mean, or just sort of they're racing to just get the money and the valuation, and acknowledging some of the different terms that are in there and understanding why they're in there is always a really useful conversation to have.
Okay.
And so if you get to the point where somebody hands you a signed term sheet, from there it's really kind of off to the races. And if you're on the investor side, that usually involves an exercise in legal due diligence, where you have to you submit a questionnaire to the company, and they basically, dump a huge amount of information into a data room that you sort of sift through, and you produce a high level kind of red flag due diligence report that's just looking for kind of, landmines, anything major in there, like a founder who exited, who might still have shares, or somebody who owns the IP that the company is relying upon to create its product, for instance.
Okay.
So you're just looking for things that are potentially landmines or big errors that could impact the value proposition.
Yes.
From the company side, you're then in a position where you're talking about kind of drafting or reviewing the draft documents that are being produced by the other side. And then kind of getting your house in order as far as the things that need to be done to fix the things that come out of due diligence, for instance, but also in a growth company, particularly lining up your existing shareholders and your existing stakeholders and getting them lined up and getting them prepared for the fact that they're going to have to execute a whole bunch of documents soon, and to kind of be there ready to respond quickly, because in order to close a deal quickly, if you've got a cap table that's full of a lot of angels, a lot of investors, getting everybody kind of herded together to execute the documents and make sure you can execute efficiently is a hell of an exercise sometimes.
Yeah.
So there's a lot of kind of logistical project management on the company side when it comes to execution, and then just the meat of the documents itself and the negotiation. That's on both sides of the fence, investor and company.
Okay, fantastic. So, yeah, there's a lot there, a lot to digest.
There is. Yeah.
So I guess, first key insight is don't come with a signed term sheet. Make sure you get a lawyer involved before the term sheet is signed, because then you're able to help out with the due diligence and the drafting of the required documents before lining up all of the investors or existing shareholders.
I would say get a lawyer involved as early as you can. As soon as you're in the phase where you either start receiving term sheets,
Yes.
or you're in conversations you expect to receive term sheets, line up a lawyer. And most of the good ones will happily have a conversation with you about anything that's in the term sheet and won't necessarily charge you for it.
Yes.
Because getting to a signed term sheet is in everybody's interest. So I don't know any lawyers out there who will start charging you thousands of pounds just to look at a term sheet before that even gets signed. And I like to think that most of us are pretty reasonable in that respect. So get them involved earlier, because like I said, once you get to that point where a signed you get a signed term sheet, that will make the long form documentation process easier.
Okay, fantastic. And you've mentioned come in as early as possible, and that's a really good insight for founders. What other sort of main considerations would you give to founders? I'm going to exclude investors from this question, because I imagine they're going through this on a regular basis. So what other broad considerations or recommendations would you give to founders who are thinking about raising?
So I think early stage founders, if I'm to think that, we come across the same issues, which are a messy cap table, documents that they don't have in place, that they just maybe haven't thought about because they're so early stage, and the repercussions that flow from that. So when you're talking about cap table, for example, you can have a situation where, let's say you and I formed a company and we just hold one share each, for example.
Yes.
That's not ready to take on investment, because you probably have, we've got a denomination in shares that's probably £1 each. You can't then cut in an investor for 15% and give him like a fraction of a share. Like, that's just really messy and untidy, and you can't really construct that in a good way.
Yes.
And so setting up a proper cap table that's ready to take on investment would probably involve, for instance, subdividing our shares into 1 million shares each, for instance.
Yes.
Because then once you get the higher number, you can bring in investors and be more precise about their shareholding and be more precise about the price per share at which they're investing in at.
Yes.
And that also has the benefits of, for example, when you're setting up an option scheme, to be able to award your employees 40,000 options instead of 4 options. Optically, it's like a nicer thing to be able to do, and enables you to be a lot more precise about your percentages and about your shareholdings. So having your cap table in order is one thing. And as I mentioned, and it happens a little bit more frequently than I'd like to happen, but you often have founders who started off, let's say, as 3 people, and then one of them has exited for some reason, and they've just thought, okay, he's exited, and whatever, he just gave back his shares, or we just assume he's not part of the company anymore, but he's still sitting there with shares on the cap table. That sort of stuff needs to be cleaned up before you take on an investment.
Indeed.
And then the second thing I mentioned was documentation that perhaps you don't have in place. And the most common one of those is, as an early stage founder, if you and I set up a company, we don't necessarily put in place an employment agreement really, really early on. We're still really focused on what is our product, how do we get to market, what's our idea, etc., etc. And oftentimes we overlook an actual formal employment agreement for us with the company. But something like that, and that's when I talk about the third thing, is the repercussions of not having these documents in place. Anything that we've created in the time that we set up the company up until the time the investor puts in his money without an employment agreement is technically owned intellectual property wise by us as individuals. It's not owned by the company. And obviously the investor is investing into the company, and so anything that we've created as IP now needs to be assigned to the company and needs to be owned by the company. So an easy thing is domain names. So you may have I've bought the domain name on GoDaddy.com and I just pay for it with my own credit card, and it's under my name, Lucas, but it's got to be owned by the company. So you'd have to transfer that across to ownership of the company before the investor closes the investment. And it's making sure the investor makes sure that the company owns all of the intellectual property that we may have created in the time that we set up the company.
Yes, fantastic. Yeah, really, really good insights. I think I do know of a couple of people who have left companies and had shares on the table, and then that's complicated funding rounds later on.
If you've got an ex-founder that you've broken up with, make sure you properly document their exit from the company.
Yeah, absolutely. And I suppose people, and I'm not saying that everybody does this, but some people might say, actually, no, I don't want to bring in a lawyer because I'm worried that it's going to cost me a lot of money. And particularly when founders might be bootstrapped or they're looking at really extending their runway, they might become very cost averse. So do you have any tips for founders as to how they can keep their legal costs down whilst still, let's say, receive or seek legal counsel appropriately?
Sure. Well, so I mean, there's kind of the old saying, which is there's nothing more expensive than a cheap lawyer, right? which is weirdly enough, and obviously I've got a biased point of view, but ends up being true because oftentimes we end up with a company where we have to sort of almost clean up a mess that's been created either from another law firm, another lawyer, or like a kind of an automated, let's say like a contract kind of create automated contract system that maybe hasn't quite done things right. And so I would advise it's definitely worth speaking to a lawyer, but it's also important to speak to a lawyer that's not going to just look at you as kind of a cash cow, that's going to make sure you're sort of properly set up, but in a way in which is conducive to the way that you're growing the business. So, for instance, I've had founders come to me and they sort of say, okay, I need to put in place a shareholders agreement, articles of association, etc. And then I'll say to them, okay, well, you're super early stage at the moment. That's going to cost you, a few £1,000s. It's just you and your co-founder. There's nobody else in the company. Technically, you don't really need one, because if there's a level of trust between the two of you, all of the decisions that need to be made can be made by the two of you unanimously. So you don't necessarily need something contractually to back all of that up. And because you're so early stage, you don't necessarily need to make that legal spend straight away. So I think one of the things is to make sure you get kind of somebody who's going to give you a commercial slant, as opposed to just legally, this is what I want, and they just say, that's great, I'll go away and do it, and then I'll charge you. But to be able to sort of understand commercially and practically whether or not you do actually need that and whether or not it's appropriate for your stage. So I'd say that's one thing. And then I think once you get into the transaction itself, what tends to rack up costs from our side is when there's changes. So you sign a term sheet and you'll say to me, for example, it's a straightforward seed round. This is what the cap table looks like. We've just got one investor. Let's go. And I'll say, great, that's going to cost X amount. And then, 2 weeks later, you'll say, oh, there's another investor who's just come in. So it's going to be like a co-lead. and that investor's got a law firm representing them, and the other investor's got a law firm representing them. Oh, and then I forgot to tell you, we've got a convertible loan note that converts into the round as well. And then there's a few angels that want to do EIS and SEIS, so you have to do like 2 closings over 2 days. And all of that sort of stuff is it seems maybe minuscule from the founder's perspective, because they're like, oh, it's just a few different angels, or it's just somebody else coming in, or we're just forming the round. But those things have a real ripple effect on the way the documents are constructed and the way that the deal is done, and particularly when you're negotiating not just with one party but now with 2 different parties, and that can add on time, and time just ends up equaling money when it comes to lawyers' fees. So as much as possible, for founders, completely have your arms around what the deal looks like, who's participating, what are their requirements, and if possible, if you have multiple sort of lead institutional investors, funnel them through one set of lawyers. So if you have, let's say, one lead who's writing the biggest check, and then you have other people writing kind of reasonably large-sized checks, just funnel them all through the lead investor's lawyers, so that they're speaking with one voice.
Yes.
And if they have differing interests that they need to juggle, that all gets juggled on that side of the fence. But what you end up with is one set of comments that comes across to the other side, and that just makes things a lot easier and streamlined.
Fantastic. Yeah, and it almost seems like you could put that on a Jira board, because it sounds like the typical, all right, the sales team has requested a feature, product and engineering start building it out, but then they say, actually, no, I want X, Y, Z. Why is it taking longer? Why is it costing more?
Exactly.
So I think, planning it out and understanding those repercussions for changes is important.
I think what all those kind of, it's isn't it like a meme, or like one of those jokes they have where for service provision you can either have it quick or cheap or to a high standard, and then it's if you pick 2 of them, you have to kind of almost sacrifice on the third, and it's the people who say, it's got to be really quick but also a really high standard but also really cheap as well, and it's sort of like it's very difficult to get all 3. Very
absolutely. And you mentioned that you, let's say, provide a quote to founders when they first approach. And this is purely out of interest in terms of legal billing models for non-legal stakeholders. Do you normally take on, let's say, a fixed fee approach, or fixed plus a variable aspect? Because I suppose it's hard to predict precisely how many documents and whatnot you'll need to delve through in order to help finalize the transaction.
Mainly due to the sheer volume of deals that I end up doing.
Yes.
It's difficult to sort of get into a sort of 1 week long process back and forth about a fee structure and come up with something really complicated. So most of the time I tend to operate on pretty much a fixed fee or a capped fee basis. So, I try and give as accurate a quote as I can, and I'm really, really loath to change that or go above that. And I know it happens a lot, but I hate doing that to founders.
Yes.
And so if I give a number, by hook or by crook, I usually end up at there or thereabouts on that number. So it tends to end up feeling like a bit of a kind of fixed fee or capped fee model.
Yes.
And that, generally speaking, that I think marries well with the sort of efficient deal execution and the sheer number of deals that we do volume-wise, and that all tends to kind of stitch together quite well as far as just a way of operating.
Okay, fantastic. Well, I'm sure after so many years in the industry, you're quite bang on in terms of what's going to be required and then quoting appropriately.
Yeah.
And so again, just sort of drawing back to the years in the industry. A lot has happened. It's been almost the longest sort of bull market ever. Are you able to provide a view of the market now as we enter, let's say, a little bit more of a difficult economic period? What changes are you seeing as a result of the current economic climate?
Interesting question. So, and I've been asked it a lot of times, so I kind of have my answer. My answer, not pre-rehearsed, but I know exactly the way that I'm going to answer it, which is that thankfully, touch wood, deal activity, or at least volume or amount of work, it hasn't experienced that much of a drop-off, or at least not really noticeably.
Yes.
I think, in fact, we're probably in a slightly there's always a level where it's a little bit too busy, if that
Yes.
makes sense, that you're slightly uncomfortable. And it's a very difficult balance to strike, because as soon as it becomes really quiet, I get really uncomfortable.
Yeah.
And so thankfully it's been near about that level for quite a long time, that sort of, busy but not quite crazy, I'm really stressed out, I'm suffering kind of thing, but busy enough that there's plenty of work coming in. And we're still kind of at that level, and I think that's a symptom of both. There's been a little bit of a drop-off in the pipeline of activity and deals,
Yes.
but that's been matched with an increase in activity for things like bridge rounds and rescue rounds,
Okay.
on portfolio company triage, existing companies that need to sort of shore up, and maybe there's some employment work, or some, they're doing some cost cutting and they need to kind of reshape some of their business. So there's other work streams that come in that balance out the sort of slow up of actual venture deals. And then there's also kind of, acquisitive M&A, because there's a lot of value out there. So there's a lot of companies that, rather than look to grow through expansion or looking into new markets, they're looking to consolidate by picking off smaller players who maybe there's some good value out there for some of those companies.
Yes.
And so it remains busy on that front, and I think overall that's meant it's quite balanced. And then oddly enough, well, not even oddly enough, I think it's absolutely fair to say there are still some sectors which are incredibly resilient.
Yes.
So climate tech is one of those. Web3 and crypto and blockchain related companies are actually still very, very popular as well. So we've closed one recently, which was a massively oversubscribed round. I think friends of yours actually, who are sort of ex-founders of a very well-known company.
Yes.
And I think because of that track record, they generated a huge amount of interest and managed to close a phenomenal, vastly oversubscribed round.
Yes, yeah, and that's a really good perspective, because I think people in the tech industry think about deal flow as the only metric, whereas you've provided some really good other examples of what goes on in the background in the form of the bridging rounds, in the form of cash-rich companies being able to make acquisitions at this point in time, because I think Warren Buffett always says that the time to buy is when people are sort of running away.
Yeah,
that's
be greedy when others are fearful, right?
Exactly. Yes. Yeah.
Yeah.
And so that's I imagine what quite a few companies will be doing if they're in a fortunate enough position to do
absolutely.
so.
And when I say things like rescue rounds, a lot of those are rounds where you're either, as an investor and as the company, either looking at shuttering completely, but then with a little bit of a cash injection, you're looking at entering into an M&A process pretty much immediately.
Yes.
That says, if we can just kind of bridge through this particular period, we can potentially sell this company for 40-50 million.
Yes.
But if we don't get that bridge, we're going to go under in a very sort of short amount of time. And when you look at it in that kind of quite binary term, it's quite clear from an investor perspective that there's still potential value out there. And if you believe they can do that flip and there are potential buyers hovering around, it's almost a no-brainer to be able to do a kind of a recapped rescue round in that respect. But yeah, so we're still seeing a fair amount of activity, which is thankful. And it's also important, like you said, to realize that we've come out of this ridiculously bullish time when things have just been so busy that the trajectory has been like this. And if we dip down to even 50% of that, that's still, at some point in time, even that was still quite busy.
Yes.
And quite bullish. So I think it's important to realize, because I get a lot of calls and a lot of I speak to a lot of journalists and media publications, and the perspective they always want to talk about is, is this the death of VC? Is this the death of big tech? And is it the end? And the honeymoon is over, and everything's going to go to zero, and everything's going to die off. And it just seems such a ridiculous sort of headline, or a ridiculous story that is trying to be pushed, because, as I say, the growth has been so phenomenal over the last few years that even a pullback of, like I said, 50 or 60% is still an incredibly successful sector. It's still a very well performing asset class.
Yes.
And as with the financial crisis of 2008, 2009, there's a prevailing view, which I very much adhere to, that tech will find the way through. And so you have, out of the financial crisis, you had all of the digital banks that were born out of a need that the market had created because of that crisis. And I think you'll find a very similar thing here. Even in the pandemic, Hopin was created in the pandemic.
Yes.
And that's one of those companies that catered to something that people were really thinking was going to be, one of those things that was in huge demand going forward. And I'm sure that in this economic crisis, there'll be another way of people thinking, okay, what are the solutions that need tackling.
Yes.
And technology is usually the forum around which those problems get solved.
Absolutely. And that reminds me of something that I heard last week at Web Summit. And I know that we might be publishing this a little longer, but Web Summit, for the audience, was at the beginning of November. It was a VC, a VC, I think it was from Draper, speaking. And what they were saying was that actually there are less founders approaching them with deals. So I'm not sure whether that's a trend that you've seen, founders being, or individuals being, more cautious and sticking to like jobs, let's say, instead of taking risks and starting companies.
Yes, I think it's very fair to say that they probably are, and that's leading to some really interesting things, because with the market the way it is, there's a fairly obvious logical thought that because the deal activity is really dropping off, because it's really difficult to get funding now, that there's a huge amount of leverage on the investor side. So people are sort of talking about, have you started to see a participating preference, liquidation preferences? Have you started to see these really kind of predatory term sheets being rolled out? And although there's kind of little hints of that here and there, nothing I would call a real kind of market shift where everyone's saying, oh, now participating preference is what everybody's offering and that's just the market standard. I wouldn't say that. Strangely enough, I've been seeing sort of the opposite end of the scale, which is that there are still funds out there that have money to deploy. That's one thing. But because of the cautiousness, the threshold for what is considered to be a potentially good company is much, much, much higher. And of those companies now, there are very, very few of them, which means that if you are genuinely a hot company, like our friends in common, you have a huge amount of interest. And that gives you a huge amount of leverage, because then really you're sort of holding your hands up and saying, we're one of the only few decent companies that's actually still worth putting money into in a dropping market. And then you have almost like a feeding frenzy of investors who want to go into that company because there are just so few of them left. And so there's a bit of strange demand and supply going on between the amount of funding, which is definitely less, but has not dropped off a cliff. There's definitely still funds out there. But the even smaller, perhaps, subset of genuinely good, genuinely hot companies that can justify valuation, that have a really good team with a proven track record. And they actually end up having a lot more leverage in what people think of as a very sort of investor leverage market, investor-friendly market.
Companies which are very promising or have very strong unit economics attracting the funding. I think there's that saying, when the tide goes out, you see which ships sail and what sinks to the bottom. I think there was a huge amount of money circulating in the economy because of interest rates being so low. We're seeing some of that money now being spent, which is leading to high inflation. But eventually we'll get to a point where companies' wallets really, really tight and consumers' wallets really, really tight, and we're going to see quite a few sort of redundancies. I think big tech is going through now almost a second wave of that. So it will be interesting to see whether some of the new, let's say, the what's the saying, what comes out of the ashes, what sort of companies are going to come out of those, especially we're either going to see talented people that know how to grow companies be made redundant and then start their own, or, and this is what I find really interesting, people that join tech companies during the bull market that don't necessarily have, let's say, a main focus on strong unit economics because they were sort of neglected during the bull run. So it'll be interesting to see how that plays out.
Yeah, I mean, it's been interesting, for example, to see examples like Hopin, which was a huge success during the pandemic, but then had to start making layoffs. Klarna as well, I think, had to pull back a little bit as well, and their valuation, I think, took a bit of a hit as a result. Obviously, it's almost in some respects not to be expected, but I think it's a strong sign that there is a kind of okay, let's not mess around now. This is properly kind of recession times and a really difficult time. But
yes,
as we said, if anything, I think it's going to end up an interesting opportunity, because I would imagine you'll have ex-Meta, ex-Twitter individuals forming their own companies and founding their own companies to tackle a particular problem, and those are going to be tremendous opportunities. Those are going to be the next Revoluts, the next Monzos, the next kind of companies that come out of a crisis, and they'll attract venture funding, and they'll end up becoming unicorns, and they'll become success stories. And if anything, I think that's there's an opportunity there that I'm sure somebody is going to take up. I'd be surprised if we go through this difficult period and nothing comes out of it. No unicorns are born out of this. I'd be stunned. I'm sure there are going to be some. Yeah, it's just a question of what is the opportunity, right?
That's right, and that's the exciting thing to watch.
Yeah, and I hope they're always going to need lawyers. So
yeah, that's right, indeed. Well, look, Howard, any sort of closing remarks for the audience? Particularly given this huge track record in the VC space, and throughout multiple different sort of crises and bull markets.
I don't think there's any sort of nothing in particular. I would say just that. Listen, as service providers, we're always kind of on the fringes of things. I think founders and investors really are the kind of I think of them as sort of modern. It's a bit of a silly way of thinking it, but they're almost like modern day rock stars, right? Because I think traditionally you used to have musicians and rock stars, and they kind of had the fame and they had the money, and they were sort of they were kind of almost like the celebrities of their day. But if you think of it now, and you look at Elon Musk, and you look at perhaps Zuckerberg doesn't have that level of cool, but the stories and the interesting career trajectories and the public interest in these people is increasing along with the kind of prevalence of the market and the way that the market has gone. So if you look even at the way that culture is evolving and the stories being told through Netflix documentaries like about the Theranos scandal and about the
WeCrash as well.
Yeah, WeCrash, the WeWork scandal, the Uber drama was dramatized with Joseph Gordon-Levitt was in a dramatization of that. And I think venture-backed companies, and both successful ones and the ones which aren't successful and controversial for other reasons, knowledge of those is seeping more into the public consciousness. And I think as a result, venture as a whole is increasing its profile across the board.
Yes.
And so I think of the good investors and good founders and really successful ones as almost like the modern day equivalent of rock stars, and sort of those aspirational figures that people now look up to, like Elon Musk, for example. So,
yeah, absolutely.
So it's really interesting to be on the fringes of that and be a very, very small bit part player in that ecosystem. It's a good place to be, and long may it continue.
Yeah, absolutely. I think it's you're really at the sort of the intersection between founders, investors, and you're seeing a lot of great ideas and great products. So look, Howard, thank you so much. I guess actually one final question. What stage of companies should approach you?
So I actually I'm stage agnostic and sector agnostic. So there's no real focus either way. Yes. I think just by the numbers, I tend to see a lot more seed stage companies than I do growth stage companies. But that's just purely because there are more seed stage companies.
Yeah.
But strangely enough, coming out of 8 Roads, and 8 Roads is a growth stage company, yes, I ended up actually with quite a lot of investor side clients that did growth stage work. So quite a lot of Series C and Series D and Series E and pre-IPO work from that. So, but there's really kind of I have clients from really across the board, all fronts. But it's a slightly different thing acting for seed stage companies than it is later stage companies. Later stage I really like because there's a lot more. Politics is perhaps the wrong word, but there's so many more interests to try and juggle. Yeah. They're trying to find that kind of middle ground where everybody's happy, or everybody is as happy as they can be. Yes. Versus just nakedly representing the interests of your client and trying to screw over everybody else. It just doesn't work, right? You have to look at everybody, and you have to look at how the company's grown, how the rights have evolved over time, and that for me is a far more interesting task at hand. So I like doing growth stage work, but I think just by pure numbers, there's a little bit less of it around than there is early stage work.
Yeah, well, hopefully some of those seed companies, translate into growth stage companies later on and come back to you. But no, thank you so much for sharing all of your learnings with us today. If anybody needs a lawyer, Howard's here. So hopefully you'll continue to help founders during such an important time. And looking forward to hearing about the progress of some of your clients.
Thanks for having me on, Lucas.
Thank you so much, Howard.
Cheers.